SeizYourBusiness.com podcast with Tony Rourke and Kevin O'Flaherty.
SeizYourBusiness.com, making you money.
Share it on Facebook, share it on LinkedIn,
Twitter,
Twitter.
our blog, YouTube videos, listen to our podcast, getting so hot that it's burning up the stereo.
Welcome to the SeizYourBusiness.com podcast. My name is Kevin O'Flaherty from O'Flaherty Law. I'm joined today by my co-host, Scott Mathis from Plateau to Peak Consulting. And our guest today is Trak Patel. He's a CPA with ARC Consulting.
That's correct.
Thanks for being here with us today, Trak. Why don't you tell everybody what you do?
Sure. Thanks for having me here. So, like you had mentioned, I'm a CPA. I'm the owner of ARC Consulting. So my firm pretty much provides a variety of accounting, payroll, taxes, and some consulting type services to small businesses. So when we talk about accounting, doing the data accounting, the payroll taxes, as well as the year-end corporate and personal taxes.
Okay. And our topic today is going to be planning appropriately for business taxes. And you're going to talk a little bit about how business owners can do some taxes on their own if
Correct.
they're so inclined.
Exactly.
So how long have you been in business for?
So I started my business about 3 years ago, but been in a CPA for well over 17 years. So I worked in industry for a long time and started my own business.
Okay.
And so now I'm doing my own thing.
Outside of the tax world, are there any hard lessons you've learned as a business owner? Any pieces of wisdom that you'd like to pass on as a business owner?
Yeah. So prior to actually starting my own accounting practice, I actually owned another business prior to that. I used to own a restaurant.
Okay.
And so, which during the financial crisis, we ended up having to close it. So, I mean, I would say, from to the small business owners, it's from what I've learned in working with a lot of my clients is really knowing the business and really from a finance perspective, it's extremely critical that you know what's going on in your business. From a financial perspective.
So have
which will
someone
make you
minding
success.
the books and reviewing
Yes.
what's going on
Yes.
and making analysis. Oh, that's something a lot of people don't do.
Yeah, and what I find is, a lot of businesses, people are really good at what they do.
Mm-hmm.
So you're a good lawyer. There's a lot of people who are do a great job in making apps, selling apps, and things like that. But from a financial perspective, they're not very good, very astute from a finance perspective. So, or managing their books or understanding their business from a financial perspective. So they'll know that, oh yeah, I took in $100,000 this year and that's about it. Well, how much did you spend? Where did your money go? Did you spend the right amount? And where, so doing those types of things is extremely critical in understanding your business. And a lot of people don't do that effectively well.
And is that as part of what you do with our consulting? Is that something you help people out
Yeah. So a lot, all my clients that I do accounting and all the various different services for, as part of my service, I provide, that type of analysis for them, saying, hey, last year you spent X dollars on, say, meals and entertainment. This year you spent this. Well, why is that? Did it go up? Did it go down? Why did it go up? Mm-hmm. And so that's kind of an example. But those are some of the critical things that businesses need to look at from their books to make sure that they understand where the money is going. You know where the money is coming from. Oftentimes, you don't know where the money is going.
Sure.
So that's the most important thing. Yeah. Because as a business owner, you want the money to come in. So you go, if you, regardless of the business you're in. So as a lawyer, you know who your clients are, you know what your bills are, and your main job is to collect. Or if you're selling products, you had $10,000 in sales today. Well, where did all that money go? Mm-hmm. People don't do a good job or an effective job. Some people do a really great job and understanding how much you spend in payroll or whatever it might be. So It's really important because the bottom line is the main thing.
Yeah. Right. Yeah, it doesn't matter if you are a $1 million revenue business if you're only taking home 50,000 of it.
Exactly. I don't know if you guys have. There's a show on CNBC called The Profit. I don't know if you guys have ever seen it either. Yeah. So there's so the guy goes in to a business that's struggling. People submit their application and he goes in and helps them turn around. There's businesses that you hear they're making $2 million a year, but they're losing $200,000 a year. Yeah. And what's going on? Why are they doing that? Well, the revenue's there.
Yeah.
Where's the money going? So that's a perfect example where
What's the name of the show?
it's called The Profit. It's on CNBC.
I'll have to check it out.
Yeah.
It's interesting. I think first-time entrepreneurs always, or typically, they have that issue. They're looking for the big number,
Yeah.
not the big profit. They'd rather make $1 million a year and lose 100,000
Yeah.
than they'd just make 150 and take 100,000 home.
Right. I mean, you could
and
be
it is a
making.
struggle, so
you
you're
could,
right.
Yeah, exactly. You could be
Where's it
making
going?
$300,000 a year in revenue, but taking $200,000.
That's killer business.
Exactly. So it's really ultimately when it comes down to it is the bottom line. You
Yeah.
know,
Absolutely.
it's extremely important. And then in tying to that, obviously, if you're making money, the important part is, well, how do you ensure you're getting the maximum tax benefit
Sure.
out of it as well? So there's, a lot of different things that business owners should think about, especially from a planning perspective, because what people typically do is they're busy running their business and they're going on the fly. I need to do
Right.
this, I need to do that.
Right.
So what's extremely critical and important is, at the beginning of the year, budgeting, planning, okay, where's the money going to go? And then thinking about, well, I'm going to say hypothetically make $200,000 this year. Well, how can I reduce my taxes?
Sure.
The legal way.
Not money laundering.
Yes.
I was making a joke earlier.
Yeah.
How do you address budgets with people or not?
Yeah.
Is that something you do?
So there are some clients that don't even think about doing budgets. There's
Most.
some. Yeah. I mean, because that's the last thing on their mind. Their main thing is, I need to bring in revenue, and how am I going to do that?
Mm-hmm.
And that budgeting makes a big difference.
And so, do you help people with those budgets?
Yeah. So what's
What's
where
the strategy? How does that look? What does that look like from
So-
the big picture?
So typically what you'll do is you'll take your, with any budget, you want to take your prior year information. Where were you at?
So if you're a startup, you can't do that.
Well, with the startup, no, you can. So with any startup, so for example, if you're going out to a bank to get a loan, what is the bank going to do? Bank's going to ask for
A business plan.
Exactly.
So you're gonna make it up.
So the business plan, part of the business plan is, well, you have to put together a P&L. They're like, okay, where is your money going to come from? What are you going to spend? Because you can't just go off and say, well, I'm going to go start a business and start making money. Well, what's your plan to get there?
Sure.
So you want to start, if you're a brand new startup business, you have a plan. You have a P&L that you probably put together. Okay, well, my expectation is I'll bring in X revenue. Okay, well, what is it going to take for you to get there?
And just in case anybody out there doesn't know, P&L is profit and loss.
Profit and
So
loss.
it
I'm
just
glad you mentioned
it
that.
just pitches against what you make and what you lost.
Perfect.
Which you said they don't even look at what they lost. They're just going at what they make. So most people do a business prospectus
Exactly.
based on profit, not profit and loss. And that's
Exactly.
the other end of the banks want to know how much you're going to spend
Exactly.
to make that, and it ends up a balance of the cost of goods sold. But-
Exactly.
So what would you do with a first time continue? Sorry.
So that's fine. So with a startup, you have to start up with a plan.
Yeah.
And that will be your starting point of your budget. So, and then what I would recommend typically people do is people typically set a budget for a year and they never look at it.
Right.
Okay. And then
10
forget
years
about
later.
it. Yeah. But to be very successful, you should set a budget, as a startup, and then revisit it, especially since you're new, at the minimum on a quarterly basis.
Right.
To see, okay, are you going down the path that you set?
Yeah.
And then adjust your budget appropriately every quarter.
Right.
So how do you actually use the budget as a tool? So, in my business, payroll is what it is, and that's
Right.
our biggest expense. Excuse me. Then comes rent,
Mhm.
and
Yep.
now we're talking about supply costs.
Yeah.
So I've never actually put together a budget.
Right.
It's something I'm working on doing right now.
Sure.
But I always figure, what my costs are going to be, what they're going to be.
Yep.
If I put together a budget and, let's say we need a new computer and it's outside of the budget,
Right.
is there a time that a budget actually leads into the decision-making process?
Yeah. So, the budget is I would call it a guide, right? It helps you set a goal of, okay, this is where we want to be. And if you achieve this goal, this is the profit you're going to have. Because if you don't set a budget, you're not going to know where you spend the money. You're not going to have a plan. You're not going to have a sales plan, if you want to think about it that way. With every company, large or small, there's always certain expenses that come where were unexpected. So you have to have
You account for that.
Yes, there's always a buffer. Whenever you do a budget, you never set it where it's there's no leverage room. There's
No
a buffer
leeway.
room. Yeah, exactly. You always want to leave some room. So if there is something unexpected that comes, it's within the budget that you've set. Now, there's always going to be a case where all of a sudden you have this massive expense. Maybe, if you're a vehicle business, you have a vehicle that completely breaks down. Now you have to buy a new one that you didn't expect. Okay, that's something unexpected. Well, you have to plan for, you have to then readjust your budget accordingly and figure out, okay, well, how can I effectively afford this?
What other things can I take away from in order
Exactly, to be able to, in that situation, maybe you wanna, you borrow money and, plan appropriately. But that's where the budget helps
Okay.
to be able to plan.
Okay.
Good question.
So talk about tax planning. So, at the beginning of the year, I've got a clean slate and I haven't made any particular plans for how I'm going to allocate my business costs. Are there favorable ways to spend your money within the business that are going to be more tax favorable than others?
Well, so within a business, obviously, any type of expenses that are related to business are all deductible, 100%, with the exception of meals and entertainment, which is 50%. So, it depends on the business. Some businesses have more meals and entertainment because of the type of line of business they're in. Now,
Just to clarify, it's always interesting when accountants talk. So if I take Kevin out to dinner,
Yes.
him and his wife, because I'm trying to get him to buy into whatever my product is.
Yep.
And we spend $100.
Yes,
So you said I get 50%.
that's right.
So it's $100. So the government's going to give me $50 for that
Write-off, yes.
as a
$50
write-off.
As
Now,
a
what
write-off.
does that mean?
Okay, so
Because that's where everybody goes. I hear first-time entrepreneurs. It's always interesting. I work with a lot of people that are very new to doing their own business, and they always go, I'm going to buy my own car, and I'm going to get a lease because I can write it off. Well, if you're not making any money, you can't write it off. But what does that mean? So the 50%, we're talking about a $50 transaction. I took him and his wife to dinner. They said no. They said yes. Whatever. I can write the 50. Where does that go?
Okay, so that's a very good question. So on the tax return, in that example, if you spent $100, you put the $100 on the tax return, but because it's considered entertainment,
Sure.
by IRS regulation, only 50% of it can be deductible. So only $50 is actually deducted. So
Deducted from what?
From your revenue.
Right.
Good question. So let's say you made $100 and you spent $50.
Right.
Well, $100 technically, but you only got to write off 50.
Right.
That $50 reduces your $100 that brought in.
Gotcha.
Therefore, you now only have $50 in income that you're showing.
Gotcha.
So similarly, a perfect example, I get this question a lot. The one you brought up is around vehicles, right? So people think about, well, if I own a business, I'm going to go buy a car because I can write it off. Right. True. 100% true. Now, the one thing that people typically forget is that, let's say you buy a car at $25,000, you write it off. Now, let's say you're putting on 25,000 miles a year.
Yeah. Okay.
According to the IRS, you can deduct 25,000 miles on the tax return, if it's business related, at this year 58 cents a mile. Okay.
So you're getting to deduct what you've paid for gas and maintenance of the car.
Right. On a mileage perspective, rather than writing off the car.
So if you're writing off the car, you can't also deduct.
No, you can't. You can you can only do one. Can't do both.
Okay.
Okay.
And if you're buying the car, you're writing it off of money you make.
Correct.
So if you don't make any money, you still have to make the payment.
Correct.
Which I think is a confusion with people. You guys are like, I'll write it off. The government's not going to give you back any more than you make.
Exactly.
They're only going to let you lessen your tax burden.
Exactly. Now, you can have losses, obviously.
Yeah.
Right?
But they're not going to give you extra.
No, exactly. That loss, will just go against your personal income. So if you had other income, it'll reduce that. That's a valid point. So in that example, so people think about, I'm going to buy the $25,000 car and write that off. But the one thing that people should think about is, when they're thinking about that specifically from a tax perspective, well, how many miles do you put on an annual basis? Okay. Because you may be better off writing off the mileage than actually writing off the car. Because once the car is written off, because typically a car you write off over 5 years, or you can do what they call accelerated depreciation, Section 179, which you can write off the entire thing in 1 year. But once you do that, guess what? That's it.
Yeah.
You don't get any more write-off. Whereas with the mileage, it's every year.
It goes forever.
It goes forever. So for people who put on a lot of mileage, it might be more beneficial to write off the mileage than actually taking off the write-off on the car. So those are some things people don't think about.
And that's something you can help them do the numbers on.
Exactly. You have to kind of factor that in. Those are some of the things you have to think about.
On the $25,000 car, how long do you have before it's over?
Well, it's a 5-year depreciation.
5 years.
That's it. So 5,000 a year, let's just say, and then you're done. And then you can't.
Now, if you don't make 5,000 those 3 years, you can't do anything. Though. Right. You can't prorate it backwards.
No. That's
Yeah.
the But I mean, there's other.
The gas or the mileage, the 50.
Yeah. So
you can
with
do ongoingly, no matter how much you make.
Exactly. So if you write off the car, you can write off the gas. You can write off say any repairs, maintenance, things like that. But you have to talk to the accountant to figure out which is your best bet when it comes to getting the maximum benefit from a tax perspective.
Can you? So I've bought this car for my business. Can I put my gas on the company credit card?
Yes.
Okay. And then write that off as just a regular business.
Yeah. So
on top of the 58 cents?
No. So here's the thing. So I have some clients. This is a perfect example where I have some clients who charge on their credit card, gas, repairs, maintenance, and so on, and I do the accounting for it. But at the end of the year, I find that it's more beneficial for them to write off the mileage because they put in so many miles.
Okay.
So I'll do the mileage, and that gas and any repairs are not accounted for on the tax return.
Okay.
So I make that the accountant is responsible for doing that, making sure, determining, what's the best in your benefit to do that and doing it accordingly.
And this is an interesting back and forth, I think, but we hired an employee the other day, and we had a discussion, a roundtable thing, and they're talking about what you can write off. So say it's a W-2 employee. Can they write off clothing they have to buy if we're not supplying them the clothing, but we say you have to wear a tie?
Right. So as an employee.
As an employee.
Okay.
W-2 employee.
W-2 employee. So employees, yes, they can, but only if on a personal tax return, you typically, some people can itemize. Okay.
Sure.
So what that means is if you own a home,
right.
Like if you have property taxes and so on, it's called a Schedule A. You itemize everything.
You write everything down you spent, and then it all goes through the way.
Yeah. So you can take a deduction of all that, whichever is higher of that or the standard deduction.
Right.
Okay. Everybody gets a standard deduction based on whether you're single, married, or whatever. So that particular example you gave of uniforms goes on that return, but there's limitations. So the way it works is the first 2% of your adjusted gross income or whatever income you made is not deductible. So for example, let's say you made $100,000 on W-2 income. Okay, it goes on your tax return. The first 2%, which is $2,000, you can't even deduct.
Right.
So your expenses, your unreimbursed business expenses have to exceed that.
Right.
So if they spend, say, $1,000 on uniform, say $1,000 on personal mileage that wasn't deductible, you guys didn't pay.
So you can do it, but it depends on how big it is.
Exactly. So they can do it, but it depends on and everybody's situation is different.
So you can do it, but if it's 2,000, you're out of luck. If it's 10,000, come talk to you.
Exactly.
Gotcha.
Exactly. It depends on the individual situation. So so it's a very good question.
Yeah.
What sort of records do people need to keep for meals and entertainment and paying for gas out of their car? So let's say I buy this company car and I'm also putting gas on it.
Yep.
If I'm ever asked to prove that I was driving for business reasons versus non-business reasons.
So you're talking about audit flags.
Yeah.
What records do you need to keep so that you don't get audit flags? People going, right?
Right. Or if you do get audited, I mean, what do you recommend as far as?
So for vehicles, if you're doing the mileage, you want to keep a good record of the miles driven. So whether it's weekly, monthly, on an annual basis, the number of miles you have to prove that here's the number of miles driven.
But you don't actually have to keep like a logbook recording every trip, and this is work related for this.
Ideally, yes.
Okay.
Ideally, yes.
Okay.
But most people don't do that. But that's why one of the things that you typically, based on the business, what the IRS does is it's pretty amazing. They have statistics in their system based on the type of business you have. So if you're deducting mileage, how much mileage you should deduct. If, for example, you deducted 50,000 miles and the average in that business is only 20,000, they're like, wait a minute, this doesn't look right. It's a red flag. So those are some of the things. So that's why it's important to keep good records. And that's where your accountant helps you understand, well, this looks awfully high.
Right.
Do you have good records to show these are it could be perfectly legitimate, So you could have driven 50,000 miles, but
So if
you better have good records.
If 10 realtors send in their taxes and all of them say they drove 2,000 miles, and then the 11th one sends in and said they drove 50,000 miles, and go, hey,
Red flag.
what are you doing here?
Yeah.
It must be. And now if they've got 10 times the revenue, yeah, maybe.
Could be perfectly legitimate. So
but
yeah.
they might check.
Yes, they will. And so a weekly is probably more than sufficient. You don't have to say, if like, for example, you went to visit 10 clients today. You don't have to say I went from this client to this client to this client to this client. You can say on this day I drove 20 miles from here to here. You know what I mean? That's totals are fine. It doesn't have to be specific to that.
So for meals and entertainment, do I need to can I just have a separate business credit card that I know whenever I'm doing a business dinner, I always use that credit card for business without keeping every single receipt and writing down the person's name?
Yeah. So with the receipt piece, so that's a little bit unique. Typically the IRS, the requirements, and you can have it as part of your company policy. So you can refer to your company policy saying a lot of people, if it's under $75, a receipt typically would not be required. Okay. But once it goes over $75, then you should start keeping receipts.
Okay.
Now, the other thing is that remember, nowadays you have most people use credit cards, and you can use your credit card statements will have detailed information on there as well. So if you don't have receipts, that can be as proof.
Okay. So the credit card statement is basically the same as
pretty much. It's it's perfectly.
Just as detailed. Just as doesn't tell you what you.
Yeah, because if you go to a restaurant, and it'll tell you $20 tip, $6 in total 20. You know what I mean? It'll tell you okay, $26 you spend, and the credit card statement's going to tell you the same thing because it's got the name of the vendor.
Can I write off tips?
Of course.
Some people say you can. It's always fun to.
No, you can. You can.
It's fun to hear what people and uneducated or unsophisticated as it relates to taxes. And I'm not the expert by any means. I've had people tell me you can't write off a tip. Well, why not?
Yes, you can.
By spending at a business event? Right?
Yes, it is. It is legitimate business expense. So yeah. So from and I know there are a lot of people who probably have a lot of transactions. Some clients of mine, they have hundreds of transactions on a credit card on a monthly basis. To keep receipts of all of that is extremely voluminous. Right. So credit card statements work perfectly fine when it comes to that.
So when someone's meeting with you at the beginning of the year, or maybe for the first time, and they're saying, okay, I know taxes aren't due for 12 months, but what do I need to do to start planning in advance? Other than you giving them some of these tips,
right?
Other than what we've talked about, what are the things that you tend
from a tax planning perspective, right? So some of the most important things that people should think about also is retirement type of deductions. So SEP IRAs are very common with small businesses. So that's an extremely important piece that you should think about. As part of your, a way to reduce your tax liability. Sure. And then it also puts money away for retirement as well, because oftentimes that's the other piece businesses tend to be deficient on is thinking about, think about the present, not the future.
Sure.
And so that's the one critical piece.
And if people want to know more about SEP IRAs, we've done an episode on retirement planning. So check out one. Don't remember what number it was, but check out one of our back episodes.
Exactly. So retirement planning is extremely important when it comes to that from a tax planning perspective. And with all my clients, I always say, okay, well, based on the income level, let's project what we're going to have for 2015, and let's start putting that money away. Because what oftentimes people have a struggle with is when it comes to, like, for example, a SEP IRA, you can contribute by April 15th. So all contributions have to be made by April 15th or by the deadline if you extend your taxes, which is October.
Okay.
Or September.
So you can do the contributions after April 15th as long as you get your extension?
Yes, you can actually.
Okay. 6 months. And you only get an extension for 6 months without penalty. Correct?
Exactly. So
because some people be like, I'll just extend it again. Well, you can, but there's a penalty for that.
Right.
Whereas
that's
the
exactly
first time
right.
you get 6 months free.
Yep.
Like
exactly.
get out of jail free 6 months.
September for corporate
if,
returns.
If somebody had done that and they'd closed out their taxes, do you have a 6 month period, or do they go, oh, well, you missed it? Do you have to extend? And if you don't extend, you get no freedom?
No,
that's something I have no idea.
Yeah, so when it comes to taxes,
April 15th game, yes. I wish I closed out my taxes, but I wish I had added something. Can I get like some sort of go back for 6 months? Because I know you could, if I hire you tomorrow and I think you're smarter than my other guy, then I can go back 3 years.
Correct.
And have you look it over, but not 4. So can I retroactively go and say, can I go back and do it?
Yeah. So if you've already filed your taxes and
Done.
you find that there's expenses or there's deductions that were missed,
Right.
you can amend your tax return.
But can I add to my IRA?
So if you so that's
If I've
a little
already
bit different.
closed out taxes,
Yeah.
I can't.
Well,
Now, if I
there's a
extend them,
deadline.
I can do it.
Yes.
but
Yes. If you talk about IRA, yes. If you haven't contributed by that deadline, it's too late.
Yeah. Even if I extend,
If you extend, then you can.
but I can't like a month after April 15th go, I wish I had done that, and then extend.
No.
Okay. Good.
No, you cannot. You can't do
Sorry.
that.
That's
And
a
if you
weird
get
clarification,
an
but-
extension, I know that if you pay late, there's a late
Yes.
late filing penalty and there's a late payment penalty.
Yep.
Is that late payment penalty waived if you do the extension?
Yes, for 6 months, but then after that, not. Correct.
Well, you do have to make estimated payment.
Okay.
Okay. So when you file an extension, you do have to make an estimated
So if you
payment.
haven't made the estimated payment, you're still going to get that.
Yes, you're gonna get nailed.
But if you get a refund, then there's nothing.
Yes. Yeah. If you know you're getting a refund, then you don't have to worry about it.
Yeah.
But if you know you're gonna owe, you have to make that estimated payment.
Okay.
So let's say you don't make the estimated payment, they'll charge you with interest and penalties.
Mm-hmm.
And let's say you forgot you didn't do extend it, you're gonna get hit with late filing as well. And actually, the interest on that they charge is actually not that much because of the lower interest rates. What really nails you is the late filing and or the failure to file. The penalties are worse than the interest.
Yeah.
Much worse.
Sure.
So it's extremely important to make sure that you file those appropriate paperwork to extend the tax return filing.
I only know that because I've extended for the last 10 years, I think.
Yeah.
I never get it done on time.
Yeah. Well, it depends on, everybody's situation is different. It's complicated. If you have a lot of things
Complicated
going
and
on.
I'm lazy, whichever one. It's not at the top of my list of things to do.
A lot of people, it's not,
Yeah.
Taxes is
Is
last
there
thing.
anything else that I need as a business owner to be doing throughout the year that we can't just cover at the end of the year when I meet with you to get my taxes wrapped?
Well, the most important thing really throughout the year that any business owner can do if they're doing their own bookkeeping is to really keep good records.
Yeah.
I'll have people come in with, a box of receipts. And, that takes more time and costs more money. So if you keep good records, it's multiple things. So if you keep good records and if you get audited, guess what? The IRS will look at the fact that you kept good records, you did a good job in, providing information, they'll be more lenient.
Okay.
And if you don't, they'll see that, you don't keep good records, which means you probably made errors or mistakes on your tax return.
Or you might be hiding something.
Yeah. So more prone, and they'll be more rigorous on your audit if you ever get audited.
Okay.
So it's extremely important for any business owner to really keep good records.
Right.
So when you go to your tax accountant or your accountant to do the tax at the end of the year, they can, take that information and do it more expediently and correctly as well.
And will you as the accountant kind of show them how to keep records the first time around?
Exactly. So yeah, if whether I'm doing their accounting or they're doing that on their own, even if I'm doing it, it's extremely critical to have them do that. So with a lot of my clients, I'll walk them through, okay, here's what you need to do, because most people don't know how to do the appropriate filing, keeping the records. And I'm a big fan of electronic filing. So because nowadays,
credit card statements.
everything. I mean, because nowadays everything is electronic.
Yeah.
And if you get an invoice, if you can get it electronically, store it electronically. If you get it physically, scan it and store it electronically, because it can store forever in filings, and you can find it more easily.
Sure.
I find, and also if you think about a lot of times over time, ink fades. So if it stays in a drawer, especially with the type of paper a lot of companies use in the ink, if you have a receipt that's a year, go back into your receipt box, you'll see that it's faded. Can't even read it. So those are some of the key things that I kind of guide my clients through and helping them organize.
So you said you wanted to talk about tips for people who are trying to do their taxes on their own. What advice do you have, or is the advice just don't try to do your taxes on your own?
Well, yeah, so it depends on the, that's a very good question, because, it depends on the individual, right? There are some people who are very savvy and want to do their own taxes, which is great. So, I would recommend buying a software. There are people who do it manually, which is crazy. It's extremely complicated to do it that way. But there are software like TurboTax and other software that you can buy off the shelf and do it. But if you are doing it, if you're an individual doing it on your own, make sure you understand all the deductions that you're going to be able to take, and then deductions that you cannot take, because if you're taking deductions that you're not supposed to, red flag, you can get potentially audited, or you're oftentimes obviously get a letter from the IRS saying you can't do this, you owe X or whatever. So those are some of the key things that to remember. And then, if they from a business side of things, if somebody wants to do their own taxes, I would recommend. It's not that easy.
I've tried and failed. I had it bounced back at me by the IRS the first time I ever tried to.
Yeah, it's a business returns are a little bit a different story. There are people that want to try to do it on their own, and there's software out there. TurboTax, of course, sells software out there. I'm not selling TurboTax, but there's a lot of different software out there that you can do it on your own. But I would recommend that they get educated around taxes, because oftentimes you're not taking advantage of deductions that people could normally take.
Sure.
On the
you're
return.
probably costing yourself money rather than saving money.
Yeah, exactly. You can just go to and then time too, because if you've never done it before, it's going to take you hours to do it. And whereas if you can give it to an expert, they know what they're doing, and then they can actually ask you the right questions. By the way, based on your type of business, I don't see this expense. Have you had this expense? So those are some of the things that experts typically ask for.
Yeah.
Well, Trak, thanks so much for being here.
Oh, thank you.
If someone would like your help with their taxes or with their planning, how can they reach you?
Yeah, so they can reach me by calling me at 224-444-9047, or they can go to my website, and my contact information is on there too at arccconsulting.com.
Wonderful.
So
There's three seasons. Yeah, that's the one thing is there's 3 C's in there. So ARCC and then consulting.com.
Okay.
So there's 3 C's in there.
Well, thanks for your time.
All right. Thank you very much for having me.
Good to have you.